Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. We've been talking about this quite a bit in terms of net interest income and the need in here to really be monitoring where your dollar volume of net interest income is coming in at a monthly basis. Because as we have interest rates remaining low in here, and possibly remaining low for the coming years, is that we're seeing many banks' net interest income in total dollars starting to decline. We're seeing loan portfolios shorten. We're seeing prepayments on mortgage backs. We're seeing calls on callable securities, all of which is driving many community banks' net interest income in dollars downward. That might not be showing in terms of the bank's net interest margin, for instance. So once again, we need to be looking at these dollars. We need to be using our asset liability models to sit there and say, what would happen if interest rates stay in the static zone, stay at these current low levels? What is going to happen over the next year, next 2 years to net interest income in terms of total dollars? And we need to take action now to prevent the erosion of this. We've seen some examples where banks' net interest income in dollars is dropping to an extent that banks may not be able to cover their overhead in here. So this is a very important thing, not only for the highest performing banks, but for banks that have lower levels of overall income performance, that they need to be watching this carefully and correcting the problem sooner than later. Because as we move further and further into the year, this becomes more difficult to correct for the remaining months of 2013. So what do we do? Well, as I've said, I feel that banks need to grow in here. They need to grow particularly in the loan portfolio. They need to grow. If you can't do it in loans, you have to do it in investments, in my mind. People sit there and say, well, look at how low interest rates are. Does this make sense at this particular point in time? Well, one of the strategies that you can use, which a number of our clients are working with, is to, if they don't have the loan growth, that essentially they can look at the investment portfolio and look at, say, like taxable municipals in here. Looking at taxable municipals out in the 5 to 8 year area, looking at yields most likely at approximately about a 2.3%. You can also look at 15-year mortgage backs, even though I feel that there's risk in the mortgage-backed market if the Fed stops buying mortgage backs. But still, once again, the choices are really few. But you might consider 15-year mortgage backs in here approximately at a 165 yield. So you can use this to grow with. I think that another piece of the strategy is that you can borrow overnight versus these positions. And you say, well, that adds to our overall interest rate risk. Well, you want to be able to quantify what exactly your interest rate risk is in here. Because what we're seeing is that if you don't have the loan growth, the durations on community bank loan portfolios are shortening more than I've ever seen in my career. So when we look at that and you look at that position versus adding in those investments, borrowing overnight, you might actually find that it doesn't make that much of an impact on your bank's overall asset liability position. So you can't just look at this transaction in isolation. You need to look at it based upon the effect to the overall bank. You might feel more comfortable if you sit there and have significant profits in your investment portfolio. You take the profits and you plan that if interest rates start to head up, that you'll take profits at different points. For instance, we use the S&B trigger strategy in order to protect our profits, but also to minimize the overall losses that you might have by purchasing those taxable municipals or the mortgage backs, so that you can plan that, as my suggestion is, to set a trigger level that if the 10-year Treasury goes above 2.25%, that then that trigger will take place, where you would sell out of these lower yielding investments that you're putting on and take gains in here. You could take break even, you could take overall gains, but it's a planned process that will basically allow you to reverse out of a lot of these lower yielding securities. So once again, we're looking at net interest income in total dollars. We're looking at how to plan to go through this period where the expectation is that don't bet against the Fed, that interest rates will continue to remain low, but you can also put in a safe gap that will allow you to get out of this position if we're wrong and interest rates head higher. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.